Welcome to the Stock Market Palantir. Today, we are going to talk about MSTR. Welcome to the debate. Today, we are diving into the really unprecedented corporate pivot of Strategy Inc., what we all used to know as MicroStrategy. Since they officially rebranded back in August 2025, MSTR it's completely transformed itself from a pretty standard business intelligence firm into the world's first highly leveraged Bitcoin treasury company.
And I think that's the perfect place to start. Because while you might call it a masterful move, I'd argue that this entire structure is dangerously brittle. It's fundamentally fragile. So the core question for us today really is this. Can the sustainability of this leveraged treasury model actually survive the structural headwinds that are, frankly, inevitably coming from the world of traditional finance? Specifically, we have to talk about the looming, almost existential risk posed by major index exclusion threats.
Okay, and I'll take the position that those structural risks you're identifying are not only manageable, but that the company's very comprehensive strategy provides, all the necessary resilience and a pretty robust regulatory defense.
And I'll maintain that the massive valuation premium this stock has always commanded is collapsing under its own weight. The company faces a looming, and I mean catastrophic, forced selling event driven by pending index rule changes. And that is a structural risk they can't just engineer their way out of.
A compelling frame. Let's start, though, with the foundation of my perspective, which is it's really about resilience and innovation. This model is genuinely a triumph of financial engineering. You have to remember, this is a management team that survived the 2002 1-for-10 reverse split. The stock was trading near zero. That history gives you the context for the kind of high-risk posture they're comfortable with today. And critically, they've protected their core identity. They've kept the operating software business and launched Strategy Mosaic, which is a viable AI-powered analytics platform that serves as a really effective regulatory shield.
I'll grant you that. Strategy Mosaic is functional, and yes, that shield does prevent them from being classified as an investment company under the 40 Act, which, you're right, would hamstring their whole leverage model. But let's talk about the engine of this growth, the so-called capital engineering. They're using instruments like preferred stock, STRK and STRF, with these really high yields, sometimes 8, even 10%.
Right.
It's brilliant financial alchemy. I agree. They're monetizing the intense hunger for yield in fiat markets to go out and acquire rapidly appreciating digital capital, Bitcoin.
Exactly. It's all designed to achieve positive accretion for the common stock for MSTR.
Yes, but, and this is a huge but, the common stock only gets that accretion if Bitcoin's appreciation significantly and consistently outpaces that 8 to 10% cost of capital. That high cost is the anchor holding it all down.
Well, I see why you'd think that, but that's the calculated risk of an enterprise that is optimizing for extreme upside.
And I come at it from a different way. That very structure makes the stock itself fundamentally fragile. And we have concrete evidence. Just look at what happened in November 2025. The stock crashed, 40 to 60% from its highs? That far outpaced the decline in Bitcoin itself. That spread, that extreme beta, it points to structural failures. The market is suffering from what I'd call dilution fatigue. It's just not willing to pay 2.5 or 3 times net asset value anymore.
Volatility is the price of admission for this kind of exposure.
No. Index exclusion is the existential price. With over 90% of its assets in Bitcoin now, MSTR is the poster child for MSCI's proposed rule change. This rule would exclude any so-called digital asset treasury company from major indices, including the MSCI USA. That is the immediate, non-negotiable threat here. If that passes, analysts estimate passive funds would be forced to sell up to $8.8 billion worth of stock.
Wow.
That's nearly 3 times the average daily trading volume. We're talking about a severe liquidity crisis projected for early 2026.
Okay, $8.8 billion in forced selling would be devastating if it happened all at once. But let's dig into the mechanical contradiction here. You can see that Strategy Mosaic provides a perfect 40 Act defense. They are an operating company. Yet you argue this shield is a red herring compared to the MSCI risk.
It is a red herring, absolutely. The 40 Act compliance is about their operational status, their revenue streams. It's to make sure they aren't just an unregulated investment vehicle. The MSCI rule doesn't care if they run the best AI platform in the world. The rule is based entirely on asset composition, holding over 50% digital assets on the balance sheet. With 90% in Bitcoin, they are squarely in the crosshairs. 40 Act compliance gives them zero immunity from index exile.
I'm just not convinced by that line of reasoning, because I think it overlooks the sheer scale and liquidity Strategy Inc. has achieved. The rebranding itself, the creation of this expansive capital structure, STRK, STRF, it all signals permanence, universality. They're positioning themselves as an elemental force in the market. Now, index providers who prioritize smooth index replication above all else might be hesitant to exclude a name with MSTR's kind of notional volume.
Hesitancy isn't a rule, though.
Exactly. Data from this past November showed midday trading volume hit $2.2 billion. MSTR is among the most liquid equities in the entire world, often trading more volume than many S&P 500 components. If you exclude a security that liquid, that high volume, you risk destabilizing the index itself through rebalancing issues. I'd argue the market adapts much faster than these old traditional institutional rules are written. They have to weigh the integrity of the index against the letter of the rule.
That's a strong argument about liquidity. I'll give you that. But the institutions tracking these passive funds have zero discretion. Their mandate is strict. It's robotic replication of whatever the index definition is. JP Morgan has already issued explicit warnings. They're saying the market is already pricing this risk in, and they expect a decision by January 15, 2026. This is why institutional investors, the so-called smart money, are already distributing shares. And where's that happening? Most likely in dark pools, well ahead of any official rule decision.
Which brings us right to interpreting that dark pool dominance. Our analysis shows a striking 58.83% of short volume is off-exchange, handled in dark pools. I agree, that ratio is wildly above the typical 30 or 40% norm, but I would frame it differently. This high volume, I think, primarily indicates sophisticated, low-impact institutional activity, not necessarily a coordinated collapse.
Wait, explain that. If nearly 60% of short selling is happening away from the public eye, how is that not inherently bearish?
Because of structured financial risk management, we're likely seeing high volumes of sophisticated strategies, like cash and carry arbitrage or convertible arbitrage. So a hedge fund might go long Bitcoin or long MSTR's convertible bonds, and then they execute these large short blocks of the common stock to hedge that long exposure. Dark pools are simply the most efficient mechanism to manage that kind of structured risk without causing market slippage or, triggering panic on the lit exchanges. It's structured hedging, not speculative collapse. In fact, large volumes of short interest tied to arbitrage can often stabilize the price.
I'm sorry, I just don't buy that it's purely volatility dampening. I mean, while arbitrage certainly plays a role, the fact that this 58% dark pool ratio coincided precisely with that severe 40 to 60% correction in November, it just suggests a more ominous purpose to me. The dark pool is the perfect, efficient tool for institutional distribution. It allows massive investors to exit their positions without tanking the price on the NASDAQ. This pattern is entirely consistent with smart money unwinding large blocks ahead of the index exclusion news. They are front-running the inevitable forced selling, leaving retail traders who rely on public price discovery to, face the consequences.
Okay, but even if some institutional exit is underway, I think the market has overlooked the unique resilience provided by MSTR's retail shareholder base.
Let's focus first on why they're exiting, the collapse of the premium. The premium to NAV multiple it's cratered. It hit 1.21x in November. That means the market is now only paying 21 cents extra for every dollar of Bitcoin exposure. That's a massive psychological shift. The old value proposition, paying $2 for $1 of Bitcoin is over. And the math is unforgiving. With an 8 to 10% cost of capital from those preferreds, this strategy needs extreme, continuous Bitcoin appreciation just to break even for the common shareholder. The leveraged nature of the stock ensures MSTR will always underperform Bitcoin in drawdowns, just like we saw in November.
That's an interesting technical point, though I would frame the shareholder base differently. Strategy Inc. benefits from what I'd call sticky retail liquidity. This shareholder base is unique because many of them view MSTR ideologically. This is the HODL mentality. They treat the executive chairman as more of a figurehead, not just a CEO. This deeply committed retail resilience provides a crucial structural floor for the stock price. It prevents it from collapsing all the way to AF during a panic. I mean, the 2024 10-for-1 forward split was designed specifically as an offensive move to bring in this exact liquidity, ensuring a constant buy-side presence that institutional panic can't just overwhelm.
I appreciate that perspective on retail dedication, but have you considered the YOLO fatigue that seems to be setting in?
YOLO fatigue?
Yeah. The retail base is fractured now. We're seeing anecdotal reports of confusion, short-dated call options expiring worthless. You see it all over social forums like Reddit. And what's more, the overall retail buying power is fragmented across all these complex derivatives like the leveraged ETFs, MSTU and MSTZ. So the concentrated buying power that fueled those dramatic gamma squeezes in the past, it's been diluted. The retail floor you're describing is a lot less sturdy than it was a year ago, which means institutional selling is going to have a much greater impact now.
I mean, while dilution fatigue is a factor, the structure itself remains sound. Look, management has engineered a robust regulatory shield with strategy mosaic, securing their operational status, and they've developed a sophisticated, scalable structure for acquiring capital using the fixed income market. Now, index exclusion is a known serious risk, maybe the single biggest short-term risk. I'll grant you that. But the company's history of surviving existential threats and its ability to generate fiat cash flow suggests a high probability of managing or, circumventing this challenge. The market adaptation will happen before rigid index rules can fully exile them.
I'm just not convinced. The structural reality is that MSTR is ultimately at the mercy of traditional financial mandates, specifically MSCI's rules, and the quantitative trading flows that this dark pool dominance reflects. The collapse of the NAV premium to 1.21 is the clearest signal you can get that the market is just no longer willing to pay a huge premium for leveraged exposure. And frankly, the company's complex structure is proving to be more of a liability than an asset when it's facing systemic rule changes based on asset composition.
So the tension is clear. Is Strategy Inc. the triumph of financial engineering, where this high-risk strategy can successfully outmaneuver the rigid, rules-based mandates of the traditional financial system?
Or will the digital asset treasury model be exiled to the periphery of the equity markets by quantitative index flows regardless of the management's ingenuity?
There is certainly more to explore in the material about the long-term viability of the strategy mosaic revenue stream. But today we really focused on the acute conflict between financial innovation and structural risk. We have analyzed the tension between Strategy Inc.'s innovative Bitcoin treasury model, its reliance on the strategy mosaic operating shield, and the critical threat posed by potential exclusion from major passive equity indices, driven by its digital asset concentration and complex market mechanics indicated by dark pool activity.
Thank you very much for hearing us. Let us know in the comments what is your opinion, and if you want us to analyze other stocks, don't forget to subscribe to the Stock Market Palantir channel to catch up with more stock insights, and see you in the next video.